And where do you see clients sort of struggle the most when they're trying to go beyond 1 to 2 properties?
What are you trying to build with the portfolios? How do people get stuck on 1 or 2 properties? Why wouldn't you think bigger? And it's a real mindset shift. So the ability to think big, not have any limitations, be able to project a level of confidence and competencies as well, that's something that's quite intangible. How do we turn ourselves into the greatest income producing asset that we can be?
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Today, I'm really excited because I've got one of the top finance brokers in Australia on the show, and he's also the host of the Australian Property Investment Podcast, which I tune into quite regularly and enjoy their episodes. So today we've got Aaron Christie-David on the show. Thanks for joining us, mate.
Mate, thanks very much, Jared. Really appreciate it.
Awesome. Well, we're going to dive into your background and glean as many insights as we can on both the investing journey as well as the finance broking side. So let's get stuck into it. Tell us a bit about your history and what have you got up to with property?
Thanks, mate. Yeah, so I guess property-wise, I grew up in Sydney. So for me, young graduate trying to find my way in Sydney all those years ago, and bought my first investment property. And what do they say? You should always be embarrassed at your first, shouldn't you? And I did everything wrong, mate. I bought a 2-bedroom unit in a suburb called North Parramatta. Had awesome views overlooking the local cemetery, and it was right on a busy intersection as well. So, and I had the classic apple crumble ceiling and all the other jazz that came with it. And I'm embarrassed by it, but I got into the market, and first time buyer grants and all that jazz. So then you had to live in the property for 6 months. So you do that, and it wasn't terrible, rental yield, and we'll probably get to this in a little bit. But when I look back, I'm like, I had no idea what I was doing at that stage. But, property 1, then let me buy property 2, and that was a 2-bed over a Liverpool investment unit as well. Again, right near the train station. And mate, I pretty much was buying those on price. That's, again,
as we do, we kind of start out with what we can afford, don't we?
What you don't know is what you don't know. So I bought those 2 properties purely on price, and I thought, they'll increase in value, and they did okay. And I was able to pull money out. And shortly after we got married, so the wedding was covered through equity as well. And I bought another car. I bought a car. That was probably my vice then. Having a couple of nice cars. And I think that's something that I see. And we'll have a chat about this in more detail. But it's probably something I see a lot is the mistakes that I'm making. I still see that happening time and time again. But in terms of the property journey, then we bought a property in Little Bay, which is out towards past Maroubra. Beautiful little spot. And that's where I thought we'd start a family. And that was an off the plan unit. Again, it was like, hey, perfect. They'll be ready for when we think about starting a family. And all off the plans, that takes longer than expected. But let's say our life had changed, and it was before COVID, probably a year before COVID. And we said, why don't we make a move down the south coast of Sydney, and look, we'll rent for 12 months and just figure out, if this is the right move for us. Both of us moving out of Sydney and where we want to live and where we want to be based. And we moved to a suburb called Thirroul, and it was a great move for us, mate. Right on the beach, and paid for what we paid a 1-bedder in Sydney for rent. We got like a 3-bedroom townhouse right near the beach. So again, awesome lifestyle. And the focus for us sitting behind all this has been our business and building the business up. And then it got to a point where when we then wanted to buy a family home, we sold, pretty much sold everything, took the cash, and then bought our home in Winona, which was a few years ago. So for me, the kind of sequence in leading up to where we are now, it's like property has helped me kind of piggyback one, get to the next one, then get to the next one as well. So it's certainly been an enabler, but it's also been a huge amount of lessons learned on the journey as well. And then more recently, so since settling on our home, we've then gone and bought a large commercial property. That was, and I say that was to house our team and to be our new headquarters. Since then, we've had a massive pivot plan in our life, and we're no longer going to move into that. We're going to rent that out. And so we're going through a fit out process at the moment to rent that out. And then I've also bought another investment property over in Perth recently, which has done exceptionally well.
Oh, excellent.
that's going to be the game plan. So for us, the game plan now is, now that we've kind of got a good base of, income producing assets, we'll then look to scale up our portfolio.
Man, I love when you look back at that journey, because it's pretty commonplace that what I see from our clients that have been more successful. You start out buying what you can afford, you make some lessons, you meet your life partner, then it's time to start working out, okay, we actually need something pretty different for the family and to settle down with, which you've made the decision with. And I'm sure that property, interestingly enough, your family home will probably end up being one of your best investments as well. And your investing properties there were a great enabler for you to have that money to roll into doing that. And it's okay, to take a step backward in selling all of that to get that step forward. So do you have any regrets about the sequencing to things and how that's all come about, or is that you're pretty happy with how it all has transpired?
Yeah, I get a really good lesson around regrets. So there's nothing I can do to change that. So it's happened. So for me, there's no hitting rewind. But if I was to do things differently, yeah, absolutely, I would have bought land. And for what I bought those units for, I definitely could have bought freestanding homes in Sydney. It was just, back then you become a bit of a suburb snob living in Sydney. Like, oh, I'm going to buy a house out like far western Sydney. That's ridiculous. And I'm a product of the suburbs in Sydney, southwest boy. And so for me, I was always like, I've got to try and get out of these suburbs. So buying more, in a better area. And I feel like that was definitely a bias that I had too, as well. And then rent vesting, exactly to your point, Jared, rent vesting for me, it got us to this point, but I knew our journey was done when we were about to have a baby, and then we got notice to move, literally. And we knew the landlord knew we were going to have a baby. They were living around the corner. And I was like, at that point, I was like, never again will someone tell me where to move, like when to move, how much to pay for rent. And it's exactly what you said, which is when you have a family, security becomes so important. Like, you want to put down roots. You want to know exactly where your kids can go to school. You know exactly where your family can be raised. And at that point, it's not even about the strategy anymore. It's like, hey, we want a family home. Where are we going to put down roots?
Hard to put a price on that, isn't it?
Mate, correct. And I feel like when I meet a lot of investors and they're, single or they're double income, no kids, I'm like, it'll get to a point where now you're faced at the crossroads with this journey. You either go all in and you keep reinvesting and you have to go because you're balls deep on it, or you go, how do we sell up to then buy our dream home? And it doesn't mean that the investing journey ends. It just means it pauses for a little bit, because then you go into the stage that, one partner goes on mat leave or drops income levels, and then you got another dependent, which takes off, $50,000, $60,000 in borrowing capacity as well.
It can be a rough period, can't it? I mean, I think back to, we had our lowest sort of business profit in the year that we also had our first child. So, it's crazy for me to think, how do we even get through with what I made in that year? And you just have to go look at all the bills, check insurance, check this, cull this, went down to one Netflix app instead of 5, and, you get through. But you've got 2 girls, you were saying, just like me. So we're
girl dads. Yeah, we're on the journey, mate.
Similar understanding of that. But of course, when you then go to have your second, that's it's a difficult period to get through when you're going, back down to one income within a few years. So
one income, what childcare costs you, equivalent like private school fees, and depending what like income bracket you're on, you can be getting very, very little government support. So that again is like a gentle uppercut going, no one's really coming to save us. Like, no, there's no government support. You're penalised if you're a decent income earner, for example, as well. But again, none of that is the reason to not have kids. You do it because you absolutely want to, start a family and raise a family. But these are just the realities. And so what I see is too many people leave the home buying journey too late, which is now they've got a family, now they want to buy the home. It's like, you've actually got to stretch yourself before you have kids, as hard as that sounds, because double income, no kids is the best borrowing capacity you'll ever have. Then having one income and then effectively 2 dependents when you're trying to buy the family home, which is when it's like it becomes urgent, not important. So you want to do things when it's important, which is pre-kids. Be like, oh, what happens if we go down to one income? And it's this circular kind of argument that happens in people's heads. There's never going to be a good time. And you've seen it as much as I have. Prices are growing week on week.
Well, that's the trouble. You defer that family home, and people underestimate how hard a principal and interest loan is down the track, especially if it's this price today and 30% more when you get to it, or 50% more. It's that much harder to make that upgrade. So tell us, in reflecting back, have you got any big learning lessons that you'd put to things? And this doesn't have to be just from your experience, because obviously you go through. But the best thing I love about being in real estate is the learning lessons that I go through with my clients. And it's almost like you get 1,000 lifetimes when you've helped that many people.
Yeah, and it's so different when it's someone else, because you're so impartial, it's arm's length. Whereas when it's your own financial situation, it's too close to home. So I'm glad you went through and culled your Netflix and everything. I'll do that. We're coming to a financial year, and I will do that for the business. I'll go through and rip expenses out, because I still think we're in startup mode. We're 8 years in, and it's the same with my household. I refuse to take the kids to a cafe, for a cafe breakfast on the weekends. It's purely because that is $80 for them to eat half a meal. I'm like, no, mate, let's go to the park. Let's have some fun. Let's build memories, as opposed to kind of spend frivolously. But we'll take them on a holiday. And that to me is that's our time together. That's our time to enjoy. So I think we pick and choose when it comes to budgeting is where is our money going, and what are we focusing on? And, I speak openly about the fact that I had a pretty good car. I enjoyed buying cars. And then, then you get them on a lease through the business, and that's a trap in itself. And then, you look at what it does to borrowing capacity. And here I am telling clients, how to increase borrowing capacity. I'm like, I better take my own advice. So I had a brand new Golf GTI, beautiful thing it was. But then I was like, no, I'm going to drive into a dealership, and I walked out with a check in an 8-year-old car or something, and no lease to my name. And again, just helped me increase borrowing capacity. So that's definitely one aspect where I feel like I'm qualified to give that type of advice, because I've done it.
Just fine tuning, how you look on paper and how the banks are going to see you.
That's exactly it. And then the other one is, credit cards. Credit cards are murder borrowing capacities. I'm constantly amazed at how people will value a credit card limit over trying to get a home loan or an investment loan. I had one today. The credit card limits are $14,000, but it was taking nearly $50,000 off their borrowing capacity. That's $50,000 worth of property you could buy. I'm like, over what? A credit card that could be closed and then reopened later anyway. So it's perspective, I feel. And I think when your situation's here, you generally see through a very tunnel vision, whereas I'm looking at all client scenarios, and I get to see the good, the bad, the ugly, the incredible. And the people that have really pulled all incredible portfolios are the ones that are happy to make decisions can the credit card, can the car lease, pay out $20,000 worth of HEX, and that increases borrowing capacity, lose this financial burden that's going to hold me back, and they're thinking much bigger as well. And I think, for me, when you said what would I do differently in retrospect, I'd be finding people that could think bigger. And I didn't really have a awesome team around me, and no one takes you seriously as a 20-something-year-old, right? They're like, time waster.
Coming with big ideas, you tell people, and it's yeah, sure, sort of, attitude.
Something like this, where you can sink your teeth into podcasts, you can hear people's stories, you're finding, best in breed, you're constantly just looking at people's mistakes. And, I'm seeing heaps of Facebook groups where people are sharing. That's great. I think it's, that community sharing, it's almost like, the old property chats back in the days on a different level. And people can share their experiences. So kind of take that, pick and choose what you want to apply to your scenario. So if you're kind of stuck at one or two, if you're trying to grow a portfolio, if your borrowing capacity is not there, mate, there's so many levers to pull, but you sort of know what options you've got just to get you into the market. Once you're in the market, that's the magic. And then you can kind of piggyback and scale a portfolio from there as well. And knowing that it's not a linear journey with investing. It's going to take you ebbs and flows. You might value traveling 1 year. Awesome. So you don't want to work as hard, but then you want to come back and get your borrowing capacity back up. So dial up your work income, for example, or like what I did, I left a 6-figure salary to go and start a business, which means it took me out of the market for 2 years, right? And that's the price that I had to pay to come out of the Sydney market and not be able to purchase for effectively 2 years to then weekend to the market by that stage and, kicked up a gear as well. So there's certainly opportunity costs that you've got to be aware of.
And where do you see clients sort of struggle the most when they're trying to go beyond 1 to 2 properties? Because I think the stat is, 70% of property investors or have 1 to 2 properties, and it might even be 90%. I'm not sure. It's a pretty high number. I think it's 70% have 1 property and 92% have, less than 3 or something like that. Yeah.
Yeah. So it usually it's what I call a grass ceiling. So the grass ceiling is generally where people can't buy more property. And the frustrated investor usually has equity, but they don't have borrowing capacity. Like you can imagine such a tragedy, right? Like you've got the equity there, but you can't actually pull it out. And 13 rate rises will do that to someone's borrowing capacity. So it's understanding the game of finance that you're playing. So what are you trying to build with the portfolio? So to answer your question, how do people get stuck on 1 or 2 properties? Given that property prices have increased so significantly, and I think they still will continue to, I don't think equity is your challenge. Now it's a game of cash flow and borrowing capacity. And so don't look at the loan, look at the upside. When you're buying the property, you've got to go, the loan is simply the vehicle or the tool to buy the investment property, for example. So no one's ever buying a car going, I'm going to buy the car that has the cheapest petrol to run. That's not how you ever look at a car. You buy a car based on functionality. So no one's ever buying a property based on the loan, but everyone, when I show them loan options, it's like, I don't want to go to First Mac or someone like that. I'm like, yeah, maybe you get like $60,000, $70,000 worth of borrowing capacity. You could buy a much superior asset and the rate's a little bit higher, but who cares? So people make the mistake that they're buying a loan. You're buying a property. The loan is simply the vehicle to get there. So when I try to explain that to people, it's a monumental shift because they think they come into a mortgage broker to get the cheapest rate possible. I'm like, yeah, cool. That's part of the proposition, but it's not the answer. Get the maximum borrowing capacity, go and buy a superior asset, get better returns, then come back and see me and we can refinance this thing in a bit of time, or strip the equity and let's go again. So,
and the loan's not forever either. So, it's a dynamic thing. And as you say, like, buy that superior asset, you're sitting with a lot more equity, and in 2-3 years, you've got all the options in the world to probably refinance.
Yeah. So when you think about buying something, if you can't take it, that you buy the property, you can't take it back. Like you've bought that. But with a loan, it's simply like a temporary lease. You're just effectively having that for a short period, and you're going to chop and change it. You're going to chop and change banks and loans all the time. So again, you're not buying that loan price. It's only on lease effectively as a loan to you, and then you can go and change it back. So shifting, and so we're so conditioned. People are so conditioned to think that they're buying the loan. I've got to buy the loan at the cheapest interest rate, or buy it with the cheapest annual fee or no offsets. Like, come on, mate, we've missed the point. You've gone and spent $500,000 on an asset. Don't worry about the rate. And it sounds like I can get a little bit flippant about it. But that's the whole point. We've got to be able to poke a little bit of fun at this to go, you're missing the point when you think you're looking at the loan. Can you get the loan to buy the property? Awesome. Let's rock and roll.
And of course, a lot of people, have lending with one lender, and they often just go into the bank and get an answer as to what they can borrow and take that as the only answer. And the biggest difference I see from those that have sort of pushed beyond 1 to 2 properties is using a really great finance broker to understand exactly what you've said, that policy is just as important, and if not more, than rate. And it varies hugely between lenders, doesn't it?
Mate, spot on. Again, I'm going to say this because I've got some incredible colleagues in this industry, and the top talent in this industry versus the mediocre, there's like, you could drive a truck through it. And I feel like when you're talking, the audience that we're talking to is an astute investor. Yeah. So I don't feel like it's something that we need to like harp on, but the great brokers are worth their weight in gold because they're pushing through boundaries that, we do that much lending that we've seen pretty much every scenario. I can say this because I've tried to recruit mortgage brokers, and one of the first things I ask them is a policy question, like who does this and who does this? And they generally just look at me with blank faces. I'm like, mate, if it's a broker chat and you don't know policy, that's a real concern for me. And unfortunately, you don't get, if I'm a punter coming off the street, I don't get a chance to vet my broker because there's no way like to know who's awesome and who's not based on like knowledge and skill set and team support.
Outside view, it's hard to see, isn't it?
Correct. So I feel like there's probably so many investors that have the ability to scale that are limited by their broker or their accountant or their financial planner. Again, I'll have chats with clients and they'll say, oh, my broker was like last time, like, why would you spend $18,000 on a buyer's agent? And I'm like, that's not broker's place to say that. Or if you want to do that, go nuts. Yeah. And brokers will project their own insecurities. Like we'll get people that go to a broker and they're like, oh, I don't think you should be buying 4 or 5 properties. Are you kidding me? Like you should be going and buying 6, 7, 8 investment properties so you can set yourself up for retirement and you can have this cash flow that will let you truly enjoy life and have financial freedom, travel the world, give intergenerational wealth for your kids. Why wouldn't you think bigger? And it's a real mindset shift. So the ability to think big, not have any limitations, be able to project a level of confidence and competencies as well. That's something that's quite intangible, but you've got to go searching for it as well. So don't settle and that's hard because, mate, we're at capacity, right? So, and I've got no tickets on ourselves, but I know that like every other broker that I know, it's, top 100 or in the industry, that's pretty good. We're all at capacity. So trying to get new clients to squeeze in is a bit of a challenge, but that's where if you're organized, you're not trying to rush around to do things and you're trying to get yourself, really, there's a clarity on a property strategy and a loan strategy. We can get that to align. What's the issue if that takes you an extra month or two in the grand scheme of the next 30, 40, 50 years of your life?
And I liked how you said earlier about identifying your bottleneck and what's holding you back and what you need to work on, because if it is deposit, then you can look at your savings rate and you can look at how much equity your properties are likely to increase and get a bit of a feel for how long that's going to take. And then if it's borrowing capacity, then as you've mentioned, different policies, different lenders, taking away credit cards, tightening up the expenses, potentially increasing your rents on your properties. And then obviously there's no substitute for working on increasing your income. Like you said, you put in your overtime or your other efforts and get a focus on the job for a while or the business and ramp up your income so that you appear better in the bank's eyes. And you do need to keep growing that income in order to grow your portfolio. There's really sort of no way around that income piece being so essential. Is there? Or no, do you have some magic bullets for us?
Yeah, there's no shortcut. There's no secret to the answer. I'm like, you are your greatest income producing asset. And when I sell it to people, they'll put their efforts into their property portfolio, and that's cool. That's a passive income stream, hopefully. But you and I, we're our active income stream. So how do we turn ourselves into the greatest income producing asset that we can be? Yeah. So getting upskilled. So you and I would have upskilled ourselves that in our industry, we've now got like a unique skill set or got a unique niche, for example. We've got something that people want to work with us. So you become that attraction person. So when you're salary or PAYG, how do you become a high performer in your business or in the organization that you're in? That then in turn leads to the pay rise. And if you're undervalued in your business, you walk out the door and you get a job with a new employer, and banks will lend to you on day one, because if you're on probation, there's plenty of banks that will still do it, right? So,
and I found with my team, those that step up and do things beyond their roles and before they're even asked, they're the people that I give greater responsibility, greater salary, greater promotions to. And the two team members that are on my leadership team started out with me both from scratch and have been here 12 years. And each of them they've worked incredibly hard initially and taken that larger view to the business as well. So great when you've got people like that.
Isn't it? It's amazing. So not only does your business, your organization win, your clients win off the back of that. So really it's what I call the win-win-win effect, right? So you look at them going, if they need to bolster their income, you're going to see the value in them. Obviously, at a market rate and within reason, but you know that they're delivering great value. Therefore, their capital growth as an asset has increased, right? So, and I'll see this all the time. People will go and buy shares, and that's cool. But I'm like, I'd rather put that money towards me. Our share portfolio is very small. In fact, I don't buy shares. Bernie, my wife, buys shares. I say, mate, I'd put that into the business and I'd grow that faster, because I can actually control the outcome. Why would I put that into another business that I'm beholden to what their board's going to do, the decisions that they've got? I'd put that into this business and get a better multiple on it, and I can control the outcome. So yeah, there's probably a level, I think you and I probably had that, maybe a little bit of that self-belief or that conviction, or we'll challenge ourselves to go, I want to back myself. And the same ethos then needs to apply that if you're investing in property, that you back yourself, that when you're making, because when you think about it, you're buying, I mean, to get to a 1% investor, you're buying 6 properties. That's 6 property decisions that you have to make. That's when you break it down, it's not a lot. So you want to make sure you're getting this right. So, the team, and I think, again, you said, what do people do wrong? I think that there's this overcomplication that can come with it. Like, oh, don't buy in a trust, or buy in this. What about the land tax thresholds? Almost, I'm like, dude, I think if you buy well, you have champagne problems to then think about, which is, okay, so you're different things. And then it's okay. First 1 or 2 is very much getting your ears, getting your feet into the market, ears wet a little bit. And then after that, now we're starting to take on a little bit more sophistication in terms of, okay, where should we be buying in terms of state, land tax, entity, accounting advice. But my first suggestion is get into the market, buy well. Usually I'd say it's more critical to use a buyer's agent for your first few purchases.
You learn a lot from it.
Yeah, you're going to get set up for success, right?
Yeah, exactly. Awesome. So obviously with all the clients that your firm deals with, where are you sort of seeing people actively buying at the moment, and what sort of price points, and just give us a feel for your perspective? Because
you break it down, you've got a few segments. So the upgraders, for example, let's say, for example, they've got their own home and they're selling it, upgrading in Sydney, Melbourne, Brisbane. They're usually moving out, so that sub 1.5, 2 mils over that space. So, families that are now a little bit older. I've got my home now, I've got equity, and I want to buy a few investment properties camp as well. So they're probably got the ability to buy, and this is for most of our investors, they're buying around that 500 mark. At the start of the year, they'll probably be able to buy assets for around 400, 450. That ship is pretty much sound. Like, we've got buyers agents that cannot actually buy good quality stock that they want to put their name to for investments under 550. So it's automatically just knocking out some of those younger investors that they've got to go to very, I won't say remote parts, but regional markets in Australia to buy sub 400. And that's become a real challenge for them. So something of quality, value, good returns, not a risk type property under 400, limited. And I think they're even amazed that when the clients that we've had at the start of the year come back 6 months and we're saying, mate, the market's moved without you, and if you'd done something, then you actually would have ridden that growth. And it's really hard to say that without sounding like, I don't know, like a snake oil salesperson you should have bought earlier. But the numbers don't lie. And so you're in Perth, the Perth market, clients aren't buying in Perth anymore, sub 600, 650. They're not. They're going far north, far south.
Really sort of need to be at 650 for a house sort of to get something decent. And you can get into villas now, but they're really at sort of 550, 600 for a decent one. And then, I get asked all the time, with a budget of 400, 450, what do you do? And I've sort of run some deeper analysis on apartments and units, and they are undervalued compared to houses all around the country. So it's probably more a case of how long is it going to take you to save or actually make the jump to the next price bracket. Because if it's going to take too long, then you're probably still better off looking at a unit or apartment and getting in sooner rather than later. But again, it comes down to case by case.
Yeah, you're spot on. I think in years prior, we always would have led towards get the land. Even me at the start, I was saying I would have bought more land. The difference now is the outlook for building and building companies and supply. That's probably why units are doing so well at the moment, is because there isn't a pipeline of this supply of units to come in to soak up the demand at the moment. So,
the newer apartments are going to be so much higher in price too. So they're not even going to start building them until the established units have gone up enough to, make that viable. So.
And so, I think it is a very pro argument then to say, look, if you can get into a unit or a townhouse as a stepping stone, perhaps do it if that's where because I personally just don't feel like the market is going to slow down on, especially the unit market, because the supply side is so limited.
Does anyone that's a resident of Sydney buy an investment in their own city? I've always wanted to know.
The ones that definitely have a bias towards Sydney, that would have been me in years gone by. Like Sydney's the bee's knees. It's blue chip. It'll never go out of fashion. And that's cool, they will. But the problem is the yields, mate, are shocking.
It's pretty hard to stomach. I mean, that, and in Melbourne, I look at the yields and very hard to stomach. And Melbourne's seeming very undervalued compared to the other capitals now. I don't know what your take on it is, but the yields there are still so low. So it's a lot. It could be a long haul before that market turns around to hold it at 2.5% yield. So
yeah, Melbourne's those funny one. Melbourne is a real funny one. I didn't even unpack that on our podcast with a few experts, and it's going, is it like the opportunity, like the ugly duckling at the moment, or is it just like it's got a bad smell, don't go near it for the time being? And yeah, it could be the latter. Look, I'm not a fence sitter by any means, but it's
especially with some of the problems that need to be dug out of with the state government and how all that's looking and all the things they've piled on taxes wise. So,
and you feel like that's the lever that really gets pulled at the moment. It's, well, where can we pull money? Well, which camp's got a bit of cash? Okay, the property investors, they've had good capital growth, so stinging them with an extra bit of land tax, for example, changing the thresholds. Well, you bought now, it's too late.
I got my land tax bill the other week and I nearly fell off my chair. And I've got a very high priced asset there. So,
and this is it. And so then you go, oh.
So it really makes me think twice about buying another one in Melbourne in the shorter term.
There you go, right?
And if so, Sydney's pretty high in price and pretty difficult to get into. Melbourne, you've sort of mentioned, has its challenges as well. Where does that, I'm obviously a big proponent of Perth, and a lot of our listeners tune in to see what the perspectives are. And that's why I thought it'd be different getting someone on from East Coast who you've got a bit of a cross-country perspective on what people are doing. So
Perth is extremely attractive for East Coast investors. So to be able to buy an asset, income-producing asset, a freestanding house for $650, you couldn't dream of that in Sydney. You couldn't dream of that. Like my wife's parents live 2.5 hours south of Sydney on the south coast. There's no houses there for south of 650. And that's 2.5 hours south, right, of Sydney. The same could be said for going up north. They've been worse north because you're going to like Newcastle territory, right, a few hours north. So that's a hub within itself. You go up far west and you're somewhere in like, I don't know, Orange and Bathurst and out that way. And it's like 2 hours, and the houses there are still, over 650. So a good few hours ring outside Sydney and you're still not buying something as affordable as you could potentially buy in Perth. That's one. And then the yields as well are so much better in Perth.
Pretty much at 5% sort of minimum for most stuff around the median house price, and can be pushed up to 5.5, sometimes 6. So, and units, I mean, they're at now 7 to 7.5% yield. So if you don't have the budget for more, at least you're going to go almost close to break even when you put depreciation on, depending on how old the asset is. So, but obviously, do you have many clients buying into Brizzy, Gold Coast, sort of regional Queensland areas? Or that's really the only sort of other option for an affordable sort of type property?
That was exactly what I was just about to say, which is, North Queensland then becomes like an option. I mean, Gold Coast, that ship has again sailed, buying, of quality for under 750. So then you go in Brisbane, same thing, buying that price. So you're going to keep moving up north. Sunshine Coast, it's not. So it's going to that next market north as well.
And Adelaide's had a crazy run, and Hobart's on the nose.
And Canberra, Canberra's turned a little bit as well. So it's probably lost a little bit of favour, and no one's really going to the Northern Territory of Darwin at the moment. So
that's just scary, even though they're so undervalued, really. And the rental yields are crazy high, but I don't have the balls just quietly to jump on that roller coaster.
Yeah, and it's almost like it's going to take, I don't know, a very ballsy investor to go there, whereas you can probably get better guaranteed growth and cash flow. You're going to get cash flow, but you're going to get growth with Darwin, and that's probably what's holding a lot of people back. So you definitely want that double whammy. So the double whammy, you're definitely getting inside down Brisbane, Adelaide, Perth at the moment. You're not getting that in Sydney and Melbourne necessarily. You get the growth, but you won't get the cash flow. So yeah, for us, I feel sorry, and I genuinely feel sorry for people like owner occupiers in Perth that are now being priced out by East Coast investors. Because I see it when we live down the coast here in South, near Wollongong. Sydney money will come in and buy it. So a lot of the locals have got priced out. That means they go down further south, and that knock-on effect. So it's really the Sydney, Melbourne dollar that just goes now the Brisbane dollar that then can get them to buy interstate, and it's pushing people out even further. And you have families that want to call Perth home. We have people from Sydney that are relocating to Perth for affordability. But that's a big change. Like they're happy to leave Sydney behind and start a new life over in Perth purely for affordability and having a lifestyle. But that's what it's come to. And when I look at a lot of our younger families that are, again, double income, kids trying to buy a home in this, in that 1.5 million that don't have the borrowing capacity to do it.
It's crazy if you said that sort of price to people here, you can still get something amazing for that.
Yeah, and I think that's what happens when you live here. So 1.5 is not getting you very much. And in order to do that, then they go, well, I can go and buy 2 investment properties in that case over in Perth and get a better return. So
rent invest and sort of try and leverage yourself up like you did and I did when I was starting out as well. So
that's exactly it. So it's kind of a dog-eat-dog world when it comes to property investing, and it's like,
it's particularly hard to get started now that we're reflecting on this. It is harder for that starting out person with the price points, with the interest rates being higher, with the comfort zone of like a lot of people like to start in their own backyards, but they really need to look further afield realistically now.
And can you imagine, we got two small kids, right? We have 2 small girls. Can you imagine, this is what keeps me going. Imagine what them trying to buy property will look like in 20 odd years. That they'll laugh at me going, mate, this property here was only worth 1.52 mil. What
they'll laugh at 1.5 and say, wow, that was cheap, Dad.
Why did you buy more of them? I'm like, it's relative. At the time, it was a lot of money. And when it gets to them, it's like our parents, that property was $200,000, in the neighborhood. It's like, why didn't you buy 5 of them? What were you crazy? Like, no, we're already mortgaged to the eyeballs. And I keep saying it. As we go on in time, the property market will be the great separator in wealth. It'll be the haves and the have-nots.
And as sad as that is, we can see it transpiring and right now.
Right now, it's like the bank of mum and dad delivers, not because they got savings, it's because they got equity and they can help their kids out. That's what's helping people, kids get into the property market. It's the bank of mum and dad. So like you take that as an unfair advantage. If your family was renting, you don't have that option. So you never, to break that cycle is going to take some extreme, you need a stroke of luck to break that cycle. Marrying into money, that becomes a real thing, right? One family's asset backed through property, that changes bloodlines. It's, we talk about intergenerational wealth. That causes intergenerational wealth through property. When, someone's parents have gone and amassed a decent portfolio, you can't save that money. You can't save your way to that type of wealth anymore.
Well, we've also got our aging population, and I'm not sure what your parents are like, but mine didn't do anywhere near the investing that they should. So we're helping them out in different ways now that we've sort of set ourselves up, and I'm just grateful to be able to be in a position to do that. But yeah, it's really difficult when you leave it too long and you're already in your retirement years. Well, your future story is written, and it's pretty hard to see what government pensions and the basic sort of living gets you. So,
Jared, you're spot on. Man. It's a sad outcome because they probably could have. Imagine they bought 2 investment. I don't know your parents' situation. I can speak to mine, but imagine they'd gone and bought 2 or 3 investment properties. Their retirement would look completely different. So if we're not taking the advice that we give to our parents now and going, hey, look, we're making some tough decisions and cash flow might get a little bit tough because we've bought more properties and rates are super high. And this is what we need to do to dig our heels in. But mate, in 20 years' time, and I say this to people, in 20 years' time, people will be asking how we've done it. But I'm telling them while on the journey, this is what we're doing. We're buying properties. We're building a portfolio. We're not driving extravagant cars. We're living a, pretty sheltered lifestyle. We're not extravagant. We save for a holiday. There's just core money behaviors that we're doing here because in 20 years' time, that's when you've kind of made it. And people will be asking, hey, you did it. It's like, we had to make the sacrifices here and now. We weren't waiting on a handout from parents, for example.
Well, those money habits I've found are essential to get in place before you get the money, because then, as it expands out, you just, we kept our same sort of expenses for 4 or 5 years beyond where we probably, could have started living a lot better, just because it was habit, it was ingrained, and it all came about from those years of maternity.
They stay with you, don't you? Those habits, when you've had to go deep, and it's called like a dark place where you've had to watch everything that's coming and going out.
We had the same with our market going down here in Perth, and business was very difficult. So it taught me huge amounts.
I think that stays with you. It's a little bit of scar tissue that stays with you to go, but we've been there before and I don't actually want to go back there. So I've got to watch the dollars, because if I'm being a little bit flippant about it, we'll get to a point that we're off track financially, and then to bring it back is much harder. Whereas if we just stay the course and we run a very, very tight financial ship, it's tough to do, but you've got to stay the course.
You don't want to go back to the most difficult times.
Not at all. Not at all.
So from your perspective, just to wrap things up, where do you sort of see the landscape for lending and interest rates ahead? Because everyone on Facebook and online loves having their 2 cents worth, and we're not going to hold you to predictions, but we're at historically higher interest rates. What and when might happen, and will there be any changes on the horizon in policy?
Yeah, I mean, we love to stay close to the banks around policy, and they usually keep a pretty tight, lid on things until they're actually happy to release it. Obviously, from a competitive advantage, banks don't want to be talking about policy before it becomes, effective in market. I mean, the 1% refinance buffer, I think, is an awesome policy. Obviously, that helps people just refinance. Losing the refinance rebates was obviously a big loss, because that kind of incentivized people to switch, or kind of motivate, financially covered some cost to switch banks. So seeing that go, probably then say you could stay with your existing lender, just ask for a discount. Ring the bank's retention team or a discharges team. That's the best thing you'll ever do. Call them, say, look, I want to go, and they'll offer you. They'll throw the kitchen sink at you to stay with them. Yeah, so that's probably one bit of advice. So, it has a mortgage. When I look at the outlook for lending, there's some really good policies. I mean, CBA and ANZ do 95% for investor, which they haven't done for years. They've moved back in there. It's got to be P&I, but, still helps people get in with a lower deposit rather than needing 10% plus LMI. So that's one. Self-employed, I'd say, is probably the most underrated but best served market at the moment for lending. Typically, you needed 12, 18 months ABN registration. We can do that now in 6 months, even less in some examples. And that's with a decent lender. You can show pay slips, and then you get treated as a salaried PAYG person. So there's, that's called simple self-employed. So there's all these policies for self-employed people that haven't been there in the last few years. And I feel like that space is just opening up a lot more. Whereas so many clients that I speak to that are self-employed think that they've just got to, push down their income to pay less tax to the detriment of their borrowing capacity. I'm like, well, look, there's a way that you can do this. You can show strong income, pay yourself for 6 months, go and buy this property. So there's a way that can be called tax effective, bit of tax planning with your accountant, but also forward planning for what you're going to buy, when you're going to buy. Investors, I think the old model of purchase, release equity, strip it out, repeat, you've got to be very tactical about that now as well. Lending has changed. I was telling the team the other day, when I first started, mate, you literally could have gone and got a personal loan as your deposit, and then gone and buy that first property. And the team were laughing at me. I'm serious. You could have done it like 8 or 9 years ago. And so when you look at where lending is now, it's only going to get tougher. Like you think about years ago, Jared, the bank never cared about your credit card balance, or your limits. They didn't care about the investment property expenses or the home property expenses. They didn't care about living expenses, 5-6 years ago. All that has been introduced. And with tech, at some point they'll go.
I mean, I went for a loan a few weeks ago, and they came back like querying our private health insurance amount. And I'm just like, double the amount, if you will, or triple it, even if we entered it wrong. Like, it's so inconsequential in my mind to the size of the loan that we're applying for, but, they're querying down to the nitty gritty.
And so when you have that level of like vigilance, they're not going to suddenly just roll that back and go, oh, we're going to open it up again. Like, no, this is the new benchmark for lending. Yeah. So I look at mortgages as an asset, because what you got for lending a few years ago, you couldn't get that now unless your income went up significantly. So having a loan is actually an asset. You can draw it down and pay down, draw it back up again. Like I tell clients, like, don't ever close that loan off. You got an awesome loan, have it sitting there as available, redraw, but don't ever pay this thing off, because you've never got the ability to go and buy again. Like you're not being serviced on borrowing as well. So I know your question was around lending. That's my thing. It's not actually going to get easier. There'll be policies that come out, niches, and all sorts of UBUT campaigns for banks to win a little bit of market share. And they
Interesting little gaps, I guess, for the unserviced parts of the consumers.
Yeah, but I guess there's a couple of mortgage nits I'd say. One is I can't get a loan on probation. That's an absolute fur. You can do a loan on day one. So that's, if anyone's listening, don't ever let changing jobs stop you from getting a loan. Casuals and contractors, probably again, people have misinterpretations around what they can do there. So many banks are like for casuals and contractors too. So don't let that deter you. And I think the other one is, if you get told no, don't stop until you get told a yes. Like find a way. So keep kind of turning over every stone. Find a way. Or if it's a no, but maybe it's not yet, that's cool. Just know what you need to do in order to get into the market as well.
Awesome. Well, thank you for joining us today. Really appreciate your time and sharing your story and insights. So I'm sure there's going to be a lot of takeaways for our listeners there.
Thanks, Chad. I appreciate the opportunity, mate.
I'll put a link to your podcast in the show notes. Definitely head on over and tune into that, listeners, and link to your website if people want to reach out and get some help on the finance front. So appreciate your time.
No, mate. Thank you very much. All the best.
Thanks, Aaron.
So.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.